Hi everyone, welcome to another video. Today we are going to decode and distill one of the greatest investing books of all time. It's titled The Little Book of Common Sense Investing and written by the greatest investor of all time, John C. Bogle. Everyone's heard of Warren Buffett. He once commented that if you don't know anything about investment, invest your money in a low-cost S&P 500 index fund. And guess what? John C. Bogle was the inventor of index funds. So the first question that comes to our mind and which I want to answer is, what is an index fund? An index fund is money pooled together to be invested in a basket of stocks. The most common index you might have heard of is the S&P 500 index. It consists of the 500 largest publicly traded companies in the United States, and based on their market capitalization or based on how much money they earn, they contribute a percentage to the index. For example, if there are say 5 companies that made up an index named FU, and if one of the companies contributed 40% to the total revenue of that index, then that company would have a weight of 40% in the index, which means if you invest $100, $40 out of those 100 would be invested in this company. Now that we have understood what the stock market is, what the index fund is, let's move on to the second question that the author tries to answer. Why should you invest in an index fund? What is the benefit? Why not invest in individual stocks or give my money to a stockbroker or a money manager? The author provides a fair perspective. He says that an average person doesn't have the time to pick and choose a stock, since it requires detailed and methodical studies around the revenue, the price to earnings ratio, and other complicated metrics. And therefore, we hand our money to a money manager. The role of the money manager is to study individual stocks and invest your money in a stock that they think would perform best. And that's where the catch comes in. The money that we give to the stock picker is not completely invested in the stock market. There are hidden costs like expense ratios, fees that need to be paid to the money manager, turnover fees, and other hidden costs. And the general expense ratio or the cumulative expense ratio for mutual funds or actively managed funds is on an average 0.5%. The author says that this seems like a low number, and yes, indeed it is low. But guess what? Vanguard, which is one of the largest index fund brokers, has an S&P 500 index fund that has an expense ratio of 0.04%, which is around 92% lower than actively managed funds. And that's why the author John C. Bogle really professes this and encourages everyone to invest in index funds rather than actively trade securities or in mutual funds. Furthermore, the author gives an example that if in 1980 you invested $10,000 in the stock market, or if you invested $10,000 in the S&P 500 index fund, you would have walked with 70% more money than if you had invested in an actively managed fund. And that's the simple reason the author says that one must invest in a low-cost S&P 500 index fund. The third point the author tries to convey is that not all actively managed funds perform below the S&P 500 index fund. There are some actively managed funds that perform way better than the S&P 500 index funds consistently for 5 to 6 years. But maintaining this consistency across 10 or 20 years is extremely difficult. More likely than not, there is a specific fund manager who is extremely experienced and seasoned, and solely because of him or her does the actively managed fund perform exceedingly well. The author further goes on to say that what if this person, this superstar money manager, retires? What then? Will the mutual fund perform better than a S&P 500 index fund? Your guess is better than mine. And therefore, for consistency and simplicity, the author recommends to invest in index funds. Another thing that the author talks about is actively managed fund marketing. Actively managed funds market their product in specific ways so as to attract more consumers, more money into their fund, and this directly translates to more profit, more money, etc. The author also talks about the marketing techniques that are utilized by actively managed funds. Generally speaking, actively managed funds market their product in a way that may be misleading. They profess rates of returns that are much greater than the actual rate of return. This is because there are hidden fees that I spoke about in the start of the video. The hidden fees include several things. There are expense ratios, there are turnover fees, there are money manager fees, etc. And therefore, calculating the actual rate of return rather than the net rate of return is super important for the average consumer. Finally, the author asks the common investor to beware of fads. Every generation has new fads. The latest ones are cryptocurrencies, NFTs, etc. The author tries to caution investors like you and me to be cautious of these new fads. There are new actively managed funds and new companies and new investing schemes that keep popping up year after year, and the author says that one must never lose focus of the principle of investing. Investing is a long term. Investing is believing in the American economy. Investing is diversifying your risk, and therefore the author cautions us to not get distracted by these new investing schemes and fads, and focusing on the basic principles of investment, and that will always guarantee you your fair share of profits. And that concludes the top 5 learnings from the book, The Little Book of Common Sense Investing by John C. Bogle. Recapping what I said, the first rule is to invest in a low-cost S&P 500 index fund. The second rule is there is a huge difference between actively managed funds and index funds. Rule 3, beware of new investing schemes and new investing fads. Rule 4, don't be distracted by the marketing techniques used by different actively managed funds. Rule 5, always understand the hidden costs associated with an investment product. And that said, if you like this video, please hit the like button. If you want to learn more about finance and technology and how to be productive with your time, please consider subscribing to this channel. It really motivates us to create more content like this, and since this is a new channel, I'd really request everyone to subscribe to this channel and help with the YouTube algorithm.